Welcome to Talk Tickers. Today, we're digging into the wild story behind United Community Bank's Q4 2025 earnings call. We're going to break down how a pre-market panic completely flipped into a major rally and what that tells us about where this bank is headed.
So what's going on here? How do you get an earnings beat, a credit scare, and a 7% stock swing all in one day? Well, it's a classic Wall Street tale of two completely different stories hiding in the same set of numbers. On one side, you had a credit issue that had investors heading for the hills, but on the other, a story of incredible strength in the company's core business. We're going to break down both sides.
Okay, so let's first get into the bear narrative. What had the market so spooked? When those first numbers hit the wire on January 14th, before the market even opened, things did not look good. And that's really where our story begins.
So you look at this, and at first glance, it's kind of mixed, right? A tiny 2-cent miss on GAAP EPS, but hey, a solid beat on revenue. So a mixed report. Why the panic?
This was the number. This is what sent shivers down Wall Street's spine. Net charge-offs, that's the loans a bank basically gives up on collecting, spiked to 34 basis points. Now, to put that in perspective for you, UCB is normally humming along in the low 20s. So yeah, this looked like a major red flag. It screamed that maybe, just maybe, something was wrong with the bank's loan.
And this timeline just perfectly captures the roller coaster of the day. The stock was tanking pre-market, down over 4% because of those credit fears. But then, the earnings call starts. Management starts talking. And the stock doesn't just recover, it flips completely green, closing the day up almost 3% on heavy volume. So the million-dollar question is, what on earth did they say on that call?
And this is where the whole story flips. Let's talk about the bull narrative. What did the optimist hear on that call that completely changed everything? Well, it all boiled down to two things: margin strength and capital returns.
You know, this is really the slide that started to turn the tide. While everyone was freaking out about charge-offs, the bank's core engine was just humming along beautifully. Look at this. Net interest margin, the NIM, actually expanded. At the same time, their cost of deposits fell. That's a huge deal. On top of that, their key capital ratio was rock solid. This was the real story brewing under the surface.
And if that wasn't enough, the CFO, Jefferson Harrelson, basically poured gasoline on the fire. He came out with explicit guidance saying, and I quote, "I would expect the NIM to be up between 2 and 4 basis points in the first quarter." Whoa, that's not just a good quarter. That's a signal of sustained profitability. For the bulls, this was exactly what they needed to hear.
But the good news didn't stop there. During the Q&A, management really laid out a clear, confident, and very shareholder-friendly strategy for 2026. They were leaning into what was working, and they had a plan.
So here's the game plan in a nutshell. First, focus on smart, organic growth. Next, keep a tight lid on expenses. Then, get that credit picture back to normal, back in that 20 to 25 basis point range. But here's the real game changer. They're shifting focus away from hunting for acquisitions and getting, in their own words, more assertive on share buybacks. So, what about that scary charge-off number that started all the drama? Well, it turns out it was pretty much a red herring. Management explained that the entire spike was because of just two specific loans. They called them idiosyncratic, basically one-off weird situations. One was a messy franchise dispute, the other was a simple paperwork error. The key takeaway? This wasn't a sign of some systemic rot in their loan book.
And this slide really hammers home that strategic shift. The CEO was super clear. M&A opportunities are light. The bar for doing a deal has, quote, honestly gone up. So instead of chasing deals, what are they doing? They're getting more assertive on buybacks. They even bought back 1 million shares last quarter for under $30 a share. That is a massive signal about where management thinks the real value is, in their own stock.
Okay, so we've heard the bear case and we've heard the bull case. Let's put it all together and talk about what comes next. What's our take on UCB going forward?
For the next earnings call, it's all about execution. We're going to be watching 3 key things very closely. First, that NIM's trajectory. Do they deliver on that expansion? Second, charge-off normalization. Do we see those losses fall right back into that normal range? And third, the buyback pace. How aggressive are they really going to be? These are the catalysts that will prove if this bull story has legs.
And it's worth remembering, even with all that earnings day craziness, UCB has been on an absolute tear. Just look at this chart. Over the last 3 months, it's crushed the regional bank ETF and the S&P 500. So the market is clearly starting to buy into this stronger narrative.
So when you put it all together, the strong operational momentum, The credit scare being explained away and this clear shift to capital returns, we're siding with the bulls on this one. We are initiating our coverage on United Community Banks with an outperform rating.
So here's the core idea, the trade thesis, if you will. We think the market overreacted big time to that credit headline, and it's still underappreciating just how powerful this combination of margin expansion and share buybacks is. Our prediction, as those charge-offs normalize in the first quarter, we expect the stock to re-rate higher. The rally we saw on earnings day, we think that was just the opening act.
And of course, please remember, this is not financial advice.